Hi guys, welcome to Dhan. Today we will be talking about a few important corporate events that take place in the stock market. By the way, those who are wondering what a corporate action is, well, it's nothing but an event carried out by the company that materially impacts the stakeholders. The implementation of corporate decisions depends on the approval of the company's board or the authorized stakeholders. All corporate actions have a different impact on the stock price. We will decode them one by one. So let's get started. The first corporate action that we'll discuss is dividend. Let's take the example of ITC here. They made an EPS, that is earnings per share, of 12.37 rupees last year. EPS is nothing but earnings on a per share basis. Out of this, the company distributed 11.50 rupees as a cash dividend on a per share basis. This technically means that if I were holding one share of ITC, the company would have paid me the 11.50 rupees as dividends last year. That's a payout ratio of approximately 93%. Quite high, right? Well, that's how mature companies function. On the other hand, if you were to look at a growing company, you'd have seen the company retaining most of its profits and using it for further expansion. That's the reason why we commonly say that profits act as a source of capital for growing companies to grow further. In most cases, you would not see growing companies declaring dividends, or even if they do, the payout rate is on the lower side. As an investor who wants regular cash flows, investing in dividend-paying companies might be a good idea. But we haven't answered a very important question here. What impact does a dividend have on the stock price? Say for example, ITC declared a dividend of 6.25 rupees. On the dividend rate, the share price of the ITC shall reduce by this amount. So make sure you witness the change the next time your stock goes ex-dividend. Before we move further, I would like you to understand the important dates in the dividend cycle. Number 1. Announcement date. The day when dividends are approved by the board. However, final dividends would also need to have the shareholders' approval at the AGM. This is subject to approval at the AGM on 20th July 2022. Number 2. Ex-dividend date. The cut-off date before which one must buy the shares of the company in order to receive the dividends. In case you purchase it after the ex-dividend rate, you wouldn't receive the dividends, but the seller would. Number 3. Record date. On this date, the company determines which shareholders are eligible to receive the announced dividend payment. The shareholders' names that appear on a company's record at the end of the record date are considered for a dividend payment. Generally, there's a difference of 2 days between the record date and the ex-dividend rate. This is because India follows a T+2 days settlement period. Number 4. Payout date. It is the date on which the company distributes the dividends to its shareholders. You generally receive the dividend within 30 days from the announcement given. It is an interim dividend. And in case if it is a final dividend, the company needs to distribute it within 30 days from the annual general meeting. Now there is a very interesting thing about dividends. The companies can pay them in kind as well. In kind? Oh yes, you heard it right. Now the second corporate action that we will discuss is stock bonus. A bonus issue is a stock dividend allotted by the company to reward the shareholders. The bonus shares are issued out of the reserves of the company. These are free shares that the shareholders receive against shares that they currently hold. The company generally fixates a ratio such as 1:1 or 1:2. If the ratio is 2:1, the existing shareholder gets 2 shares for every 1 share that she holds at zero cost. So if someone owns 100 shares, they will be issued 200 additional shares, making the total holding stand at 300 shares. Similar to dividend announcement, there is a set of timeline for issuing stock bonuses too. However, one thing to notice here is that stock bonuses do not really impact the value of your holdings. For example, if you originally had 100 shares worth 100 rupees a piece and there is a bonus issue of 2:1, in that case the share price will come down to 33.33, making sure your investment value is unchanged at rupees 10,000. Then why does a company go for a stock bonus in the first place? Well, to increase liquidity and encourage retail participation. The third kind of corporate action that we'll be discussing is stock split. The meaning of this corporate action is quite obvious. The stocks that you hold are split into parts. When a stock split is declared, the number of shares held increases, but the investment value remains the same. The stock split though concerns the face value. If the face value was 100 rupees before and then it's a 1:2 split, in that case the face value would change to rupees 50. So 1 share owned before the split increases to 2 shares after the split. Like stock bonuses, stock splits also have no impact on the investment value. For example, if you had 100 shares worth rupees 100 apiece, after the split of 1:2, you would hold 200 shares worth 50 rupees apiece. This keeps the investment again at the same value of 10,000 rupees. Again, the company engages in stock split to improve liquidity and retail participation. The fourth corporate action that we need to know about is rights issue. This is an interesting one. Under the rights issue, a company makes an offer only to its existing shareholders to buy additional new equity shares in their company, generally at a discount to the market price. We can understand this with Reliance right issue offer that came in 2020. So for every 15 shares held on the recent date of 14 May 2020, the shareholders were entitled to buy the rights for 1 share. So if someone held 345 shares of RIL, he or she would be eligible to purchase the rights for 23 shares. That is, they could buy 23 shares from the company at an issue price of 1,257. The idea with the rights issue is to raise fresh capital and give the existing shareholders the first right. However, the shareholders must be a little cautious here, because in this corporate action, he is the one making the payment to acquire additional shares. Hence, one should apply only if he is fully convinced about the business model of the company. The last corporate action we need to know about is shares buyback. This means that the company buys its own share from the investors in the market. Buyback reduces the number of shares outstanding in the market since they are bought back by the company. Obviously, the price offered for the buyback is generally on the higher side compared to the current market price. That's why investors would be willing to give the shares back to the company. There could be multiple reasons why the company would buy back its shares: to improve profitability on a pre-share basis, reward existing shareholders, or simply show the confidence of the promoters in the company. These are some of the reasons why a company generally engages in a share buyback. Don't want to miss out on any of these corporate actions that we're talking about? Go to the watchlist section on the Dhan app and check the corporate actions feature. You will be able to see all the upcoming corporate actions there. Hope you found this video useful and subscribe to our channel for more such content on trading, investing and finance.